Let's jump right in. We are currently watching one of the most fascinating collisions in the modern economic world. On one hand, you've got India's massive macroeconomic trajectory, right? Booming digital transactions, a rapidly rising middle class, just this incredible 21st century growth story. But right on the exact opposite side, lurking just beneath the surface, is a massive, glaring vulnerability. We are talking about a staggering protection deficit. So today, in this explainer, we're unpacking a definitive source document to figure out exactly how the Indian private life insurance sector can fundamentally transform to solve this crisis and, at the same time, capture an absolutely unprecedented commercial opportunity. 2.7%. I want you to really think about that number for a second. Despite having a population of over 1.4 billion people, life insurance penetration in India is stuck at a mere 2.7% of GDP. That literally makes India one of the most underinsured major economies on the planet. Millions of families just don't have basic, pure risk mitigation. They are completely exposed if their primary wage earner suddenly passes away. And this demographic deficit exposes a pretty harsh reality. We often hear this stat thrown around that there are 300 million active policies in India, which sounds great, doesn't it? But the catch is, those policies are incredibly concentrated. Affluent, urban centers enjoy roughly 78% coverage. Meanwhile, in the deep, rural, and semi-urban pockets, that number plummets to a dismal 8%. So the industry is basically operating in this wealthy echo chamber. So here is our quick roadmap for today's explainer. We'll start with the Great Indian Paradox, move into the economics of pure protection, then re-engineering corporate structures, the digital integration revolution, omni-channel distribution, and finally, the roadmap to 2030. All right, let's dive right into sections 1 and 2, the Great Indian Paradox and the economics of pure protection. Now, you might be wondering, if the Indian life insurance industry is pulling in massive profits, we're talking over 55,000 crore last year, why on earth is it failing to actually protect the masses? Well, the answer lies in the unit economics, specifically a metric called the VNB margin, or value of new business. Think of this as the profit locked in from new policies. Check this out. Pure protection insurance, like your basic term plan, pulls in a massive 25 to 40% margin. But investment-linked plans, like ULIPs, they only pull in 5 to 12%. So pure protection is insanely profitable for the carriers. And yet, because consumers have historically treated insurance as just a tax-saving investment, carriers keep pushing these low-margin savings instruments just to hit short-term revenue goals. They are quite literally leaving their most profitable product on the table. Which brings us to part 3, re-engineering corporate structures. To actually capture this high-margin market, private carriers have to fundamentally tear down and rebuild their internal corporate machines. And the absolutely crucial point here is pivoting product design. The old way relied on the traditional urban policy. You know the one. A massive 1 crore cover, huge annual premiums, usually sold to a salaried professional with a perfect credit score. But what about the gig economy worker, or the agricultural laborer, or the small trader? The industry has to pivot to what the source calls sachet products. We're talking modular, unbundled policies with 5 lakh to 25 lakh covers funded by tiny weekly micropayments that actually align with gig wages or even harvest cycles. It's a total game changer. Okay, moving on to section 4, the digital integration revolution. So if we are suddenly selling millions of these small-ticket sachet policies, how do we actually onboard these massive new populations without dealing with the absolute nightmare of a 14-day manual paperwork process? The answer is a next-gen digital onboarding pipeline. By plugging into India's world-class digital public infrastructure, the onboarding friction just completely disappears. The account aggregator framework fetches verified income data with literally a single tap. Then the Ayushman Bharat Digital Mission, or the ABDM Health Stack, pulls electronic health records instantly. Zero paper. What used to take 2 weeks of tracking down tax returns and physical medical exams now happens in an automated digital blink. And central to this whole digital leap is Bima Sugam. Let's de-jargonize this a bit, right? Bima Sugam is an upcoming, centralized, open architecture public marketplace for insurance. Now, insurers shouldn't see this as some sort of regulatory threat, not at all. Instead, it's a massive customer acquisition engine. By plugging into Bima Sugam, carriers radically slash their customer acquisition costs. And when those costs go down, carriers can actually offer much cheaper, way more competitive premiums to lower-income households. That takes us to part 5, omni-channel distribution and trust. So we have the digital products figured out, but how do we physically sell them in communities that have historically been totally ignored? Well, you build an omni-channel distribution architecture. Basically, insurers need to democratize sales. I want you to imagine your local Kirana store owner acting as a digital point-of-sale person. They're a trusted face in the village, right? Now they're selling microinsurance straight from a smartphone app. Or think about embedded APIs. A farmer applies for a tractor loan on a rural credit app, and bam, a microterm insurance policy is automatically offered right there at checkout. You meet the customer exactly where they are. But listen, access without trust is completely useless, and the industry is battling a long history of deceptive mis-selling. The old way was just full of hidden exclusions and confusing multi-page legal jargon that no one actually read. The new way? The source outlines the implementation of a 3-page digital product passport. It uses clear, simple language highlighting exactly what isn't covered, along with the exact claim settlement ratios. And taking it a massive leap further, buyers will actually record a 30-second AI-driven video key fact statement. The buyer literally looks at their phone and verbally confirms they understand they are buying a pure protection plan with no maturity returns. I mean, that is an absolutely incredible technological jump to bulletproof transparency. Next up, let's talk about reimagining underwriting at scale. Because ask yourself, what actually happens when millions of these new, clean, rural applications suddenly start flooding in every single month? Traditional manual underwriting operations would just collapse under the weight. So the technological safety valve here is a high-volume automated risk triaging pipeline, and it's divided into 3 steps. Step 1 is the green track. This covers 75 to 80% of clean profiles where data verifies perfectly via the digital rails, resulting in instant policy issuance in under 5 minutes. Step 2 is the amber track for minor data gaps, which gets routed to instant smartphone telemedicals. And step 3 is the red track, which saves those highly skilled human underwriters exclusively for complex cases and high fraud markers. Now, what's truly mind-blowing about this pipeline is how they handle that amber track. The source points to this cutting-edge technology called RPPG. That's remote photoplethysmography. It's crazy. An applicant simply looks into their smartphone's front camera for 60 seconds. Then advanced algorithms read the microcolor changes in their skin to extract their resting heart rate, blood pressure variations, and even oxygen levels with clinical-grade accuracy. It is quite literally a medical checkup via a selfie. No way, right? All right, moving to part 6, the roadmap to 2030 and global playbooks. Now, it's super important to remember that Indian carriers don't actually have to invent the wheel from scratch here. They can borrow from the best in the world. Let's just quickly bounce around the globe to see what's working. Over in the UK and Europe, they use dynamic pricing via wearables. You sync your Apple Watch, prove you walk 8,000 steps a day, and boom, you get a discount on your premium. In the US, they achieve instant approvals by integrating shared fraud databases. And over in East Asia, they tackle the cultural taboo of talking about death by reframing policies around living benefits, basically marketing a death cover as a comprehensive cancer shield that pays out upon diagnosis. These are incredible, proven strategies that are just waiting for Indian adaptation. Tying all these pieces together, the source provides us with a master blueprint, and it brilliantly illustrates how everything connects. It's like a giant puzzle. We start with acknowledging the demographic deficit, then harness the actual profitability of the industry. We separate internal corporate business units to prioritize protection, deploy those digital rails of the account aggregator in Bima Sugam, push omni-channel distribution right down to the local Kirana store, and then use automated AI pipelines to underwrite the risk. That is the whole shebang. That is exactly how you solve the protection gap. So we'll leave you with this final thought. The capital is there, the digital infrastructure is already there, the technology literally exists today. So the ultimate question is this. Will Indian private life insurance carriers continue to just chase easy, low-hanging profits in affluent urban centers, or will they actually take this blueprint and finally build a nation's financial safety net for 1.4 billion people? Really makes you think, doesn't it?